And welcome back. I'm very happy to be joined now by Harry S. Dent, the author of The Demographic Cliff, How to Survive and Prosper During the Great Deflation. He's also editor of the free newsletter, Economy and Markets. Harry, it's such a pleasure to have you on the show. Thank you very much for joining me today. How are you?
Great. Nice to be here, Alan.
It's wonderful to have you as a first-time guest. I've been following you for a while. Before we begin, though, is it true your people told me that you were actually giving away a copy of this book?
Yes. HarryDent.com, free copy of the book. All you have to do is pay our actual cost of shipping at $4.95, and so it's a great deal. And then you can also get access to our free newsletter.
Okay, we're going to get into that in this interview. It's called The Demographic Cliff. So Harry, I'm going to bite. What is the demographic cliff?
Okay, first of all, we already saw it in Japan. People remember Japan. They were supposed to take over the world and dominate everything and become the #1 country in 1989, and then it collapsed. And real estate is still down there 60% 24 years later, and stocks still down 50%. We're down 80% at the worst in 2003. We forecast that downturn in the late 80s, while at the same time saying that the US and Europe and most of the rest of the world would have to see the greatest boom in history in the 1990s, because it was just demographics. Baby boom generations have been born around the world. Japan just happened to be the first. They had their big baby boom into and just after World War II, and then they had a baby bust. Well, the U.S. had their baby boom peak in 1961, and Europe in 1964, and some countries in South Korea, and others as late as 1971. But this baby boom keeps peaking in one country and region after the next. They stop spending. There's always a bubble in real estate and stocks when they're spending the most, because the longer markets go up, the more things bubble, especially with such accommodative central bank policies now. And so we're seeing this happen around the world. So we're saying, look, central banks and governments are thinking, oh, we had a big accident in 2008 and 9. Oh, it was just some little financial crisis. And if we can just stimulate the economy long enough, we'll get over this. And they keep stimulating harder and harder, especially Japan. And we never get over it. Europe keeps falling back in recession. Japan just fell back in recession, and they've been stimulating it 3 times what the US did compared to their economy at our top of stimulus, and Europe today. So it just shows fundamental trends are predictable. That's the whole point of all of our books back to 1989. Most people can see the fundamental trends are going to affect their life, their business, their family, their investments over the rest of their lifetimes. Not all the short-term political and market corrections, but you can see it today by understanding what people like you do predictably as they age in generational waves. And there's always generational waves, and immigrants only accentuate this. So again, I mean, we said back in the late 80s, the U.S. would see the greatest boom in history, 90s and 2000s, but then it would start to crack. And when it did, that's when the central banks stepped in around the world and said, oh, we can't handle this. One thing for Japan to go down, but we can't have the U.S. and then Europe go down. So that's where we're at. We started to see the next great downturn, which comes about every 39 to 40 years in these generational cycles. But now central banks are saying, well, for every dollar that the economy drops, we'll just throw in another dollar. And so that's cheating. It's artificial, but that's what they're doing for now. And the gold bugs, which I have to debate as much as the mainstream bullish economists say, oh, this is going to cause hyperinflation, all this money printing. We're like, no. When bubble booms bust, wealth gets destroyed from assets falling, and loans fail, which also destroys real money created by the banking system, and you get less money chasing the same goods, which ends up in deflation. And the only time we've seen strong deflation in any of our lifetimes and before is the 1930s. And that's a very different economy than the inflationary bust of the 1970s. So we're saying bust ahead, even after unprecedented stimulus. And when it does bust, it'll be like it started to be in 2008-9. We'll actually see deflation, meltdown of financial systems, and it's very hard to invest in that environment. You really have to protect your gains in the bubble and wait for the bubble to burst to reinvest in most sectors except for the highest quality bonds.
Okay. Now, I can see definitely that happening in terms of asset bubbles collapsing. You ask, where is the inflation? Well, maybe the inflation is not in consumer goods. The inflation is actually in all of these asset prices, real estate,
Exactly.
and so forth. So I could see that come crumbling down. What I don't see the connection with is the demographics. And you make a good point. On the surface, it all makes sense, but these things are very slow moving, very slow developing. You can point at them very far in advance. It's like an iceberg.
Yes.
Why can't the market correct for that in time if it's something that everyone can see? For instance, you say in your book, you say that Germany is even worse than Japan.
Yeah.
Why can't we correct for that in advance if it's something that is looming? It's nothing that we can change, and it's going to have a catastrophic impact. Why can't the market just do something to adjust for that before it happens?
Well, that's the most important point. The markets don't think in demographics. Economists are not trained in demographics at all. I had a heavy business education, consulted to large companies at Bain and Company and new ventures in the early 80s for smaller growth companies. And I had to study consumers and I had to study the baby boom and realize how big it was and to realize how generations come along, big surges in people and then big declines in births and immigration. And when those people grow up and do predictable things, and I can tell you, Albert, what people do from cradle to grave, when they need childcare, when their kids go to high school or college, when they enter the workforce and become productive and stop inflating the economy with their high expenses, when they buy their first home or their first car, and when they eat the most potato chips, when their kids are at their highest calorie cycle, I can tell you when people weigh the most at age 60. So what I've done since I discovered demographics in the early 80s is just dig deeper into this. And we have better information than ever. So I can tell you when people peak in spending in the US, age 46 for the baby boomers, in Japan, in most of Europe, age 47. So a new generation. Now remember how massive numbers of baby boomers in increasing numbers, like you say, gradually and slowly move up this spending wave. Then at some point they peak. We predicted in late 1989, when we predicted the Japan collapse, that the US would start to slow down on this long demographic curve by late 2007. And it did. And when things collapsed and then the real estate bust happened, central banks stepped in and said, we're not going to let this slowdown happen. That didn't happen in the 30s or the 70s, where it's one thing to lower interest rates to stimulate the economy. It's another thing to pour trillions of dollars in to keep the banks alive and to keep the economy from collapsing. And that's what they've done. We're kind of like in a coma economy. And Japan's been in a coma economy since the early 1990s. And we predicted that.
The parallels to Japan are striking. We seem to be taking the monetary policy right out of their playbook,
Yeah.
keeping the banks alive, real estate being at the epicenter of the problem. Now, in the book, you say real estate will never be the same. How was real estate, and how is it going to be different going forward?
Okay, there's a couple things that happen in the lifetime of the baby boomers that go against history. I study history as far back as anybody can study, and I know real estate goes up and down in cycles, big cycles, just like stocks and commodities. But it hasn't happened in our lifetime because first thing, we came out of the Great Depression, World War II, all the soldiers came back to Japan and the US and Europe, and for the first time, they stepped in to a middle class economy. We didn't have a middle class before the 1940s and 50s, where most people could buy homes, mortgage them over long-term periods of time. So there was a big surge in buying, exacerbated by government saying to the soldiers who survived, man, we owe you, here's some veteran loans or whatever. We're going to give you advantageous things. We had a big surge in home buying with what I call the Bob Hope generation. Now, just as they were tailing off, guess what came along? The largest generation in history, or at least for 250 years, the baby boom. The baby boom is so much larger than the generation before and even substantially larger than the one beyond it. They exaggerated demand versus supply in real estate even more, especially in all the coastal cities around the world, where people have been moving and in the southern areas of the United States. So we had two generations of real estate just being pushed up and up and up, and it finally turned into a bubble only because banks And financiers finally thought, and so did consumers and businesses, real estate's the one thing to never go down. Oh, the tech stocks burst in 2000, 2002, but real estate's great. Well, so real estate saw its final bubble in the US from 2000 to 2005, 6. In late 2005, in my newsletter, just as I was moving from Miami to Tampa, I told people this real estate bubble looks like it's finally going to burst. And I rented a house for the first time in my lifetime and saved a 50% loss and was paying rent at half the cost of what it would have cost to buy that house I moved into. So uh, that's the thing. Bubbles burst. We only see a bubble economy once in our lifetime. You have to go back to the 1920s around the world in general to see a bubble in stocks and real estate and other things and see it burst and see how dramatically it bursts and how long it takes for real estate or stocks to come back. So that's what we're seeing now. This is 2 generations later. Anybody who ever saw the great roaring 20s bubble in the Great Depression is dead or has dementia at best. And so nobody realizes this. And then Bill Clinton gets rid of Glass-Steagall in the mid 90s, thinking, what do we need this separating the different financial sectors? That was done because altogether they merged and created a bubble in the roaring 20s along with the Fed and central banks. So this is a replay of history. It's crystal clear. The only difference this time, Albert, is that governments didn't just lower interest rates like they did in the early 30s to try to stimulate borrowing and build some infrastructure. They have just poured about $11 trillion globally, 4 trillion in the US alone, into the economy to offset the decline. That's like keeping a bubble going forever. That you can't do that, and you can't create real growth from artificial stimulus. So I think we're coming to the end of that. Okay, we had 2 real bubbles because of enthusiasm and positive demographic and technology trends, which have all peaked. Now we got an artificial bubble that has stretched this farther than ever. And my view is very clear. When this bubble bursts, and it looks very close to me, I think by near term to January at the latest, this bubble is going to start to burst. The China bubble has already led the way. Their real estate bubble is going to be the next. China's bubble is so much larger than anything we've seen in modern history that when China blows, the whole global economy is going to blow, especially real estate. So I think we're close to this. And history is clear. Bubbles build strongly, but they burst twice as strong and they go back to where they started. So I've got clear targets for the Dow in a year and a half, 6,000 give or take, and ultimately maybe 3 or 4,000 before it turns around. I got real targets for real estate. We're going to go back to the 2000 lows in real estate before the bubble took off, maybe a little lower. And that is still 40% or 50% lower than real estate in the United States here. And think about London or Vancouver or Sydney, Australia. The bubble kept going higher and hasn't even burst at all. So I think we got a big reset going. I hate to be so bearish, but I tell people, look, who was the most bullish economist probably in U.S. history in the late 80s, early 90s, when everybody thought the U.S. was done and the Western world was done and Asia was going to take over? I said, no, Japan's going to collapse. We're going to do great. Now I'm saying it's time for the Western world to go down and the emerging world to emerge out of these ashes. And China's the only exception because they've so overbuilt that it's going to take them a long time to get over that. But the rest of Asia and India, oh my God, in the coming decades, that's going to be where the world's going to go. Demographics is the only key indicator. We've got other good cycles, but the only key indicator that I can scientifically project, like you said, into the future, exactly when people are going to spend money, save money, borrow money, buy potato chips, buy houses, anything you want to know, I can tell you cradle to grave.
Um, when you talk about real estate, and you mentioned in particular London, Vancouver, Sydney, these are great examples. I saw the UBS data on the worldwide real estate bubble index, and look at the number of annual rents it takes to cover the value of these homes. It's just ridiculous for those three. San Francisco is pretty crazy too. Interestingly though, in that study, Boston was not overpriced. I don't think New York was overpriced either. Do you agree with that? Do you think that prices in the New York area, for instance, are pretty reasonable?
They're not reasonable. They're overpriced, but they're not as much as the most bubbly cities. But if you narrow down to Manhattan, oh my gosh, Manhattan is so overpriced. They're selling, the biggest market's been 20 million condos. Now the real estate agents are dropping down to 5 to 10 because that's going away quick. This is all foreign buying. When these price to income and price to rent ratios get out of whack, it's only foreign buyers who are trying to launder money out of their country or to diversify it around the world, like the Chinese are doing, the Russians have been doing, the Arabs have been doing, and the Brazilians and people like that. That keeps the market going, but they eventually stopped. And the Japanese were doing this in the late 80s, and I said the real estate bubble in Japan was the most extreme at the time. It's going to burst because demographics are going to turn against it, which they did. And then the Japanese are going to stop buying in all these leading cities, and then they're going to feel it. So that's what's happening. I mean, I was just in London a week and a half ago, and man, the top end is already down 11% recently. Sales are down 14% in real estate overall. London is cracking. Singapore is cracking. New York is starting to crack. Miami's starting to crack. California, Australia are still doing well because they're more dominated by Chinese. But the Russian, Arab, and Brazilian and South American buyers are already tapering off because their wealth is being destroyed by the commodity collapse that we've been predicting for years.
Okay, let's move on to that then. What do you think about the price of oil right now? How long do you think it's going to stay at these levels?
Well, we've been predicting for years it's going to go down to, $10 to $20. And, we predicted once it broke 80, it was going to drop dramatically, which it did. It's gone down to 38. It's bounced. You always get these bounces. It's back down to 40. I think right now, short term, it looks like it's going to hold for now, but oil's going to bounce. And once it breaks below 38, the next stop is 32 and down the line to reverse this bubble, that started in the early 2000s, we're going to have to go back down to $10 to $20 a barrel. Now, it won't stay there. That'll be temporary. But I think oil is going to be more in this kind of 30 to 50 range for many, many years. And that totally kills the, promised fracking industry in the United States, the tar sands in Canada, and kills so many countries. Venezuela, every Russia, only Iran, Iraq, and Saudi Arabia can be profitable at sub $40 levels. So that's a big consolidation of oil, and it's going to go lower. I don't see it happening quite yet, but I'd say in the next year, oil is going to be at 32 bucks, and within a few years past that, it's going to be at 10 to 20.
Wow, I mean, even if it's temporary for a year is catastrophic for a lot of companies.
Well, and yeah, and a lot of defaults. I mean, there's 20% of the junk bonds issued in the last few years have been in the energy sector and largely to frackers. So imagine the defaults there. And remember what happened in the subprime crisis. That was the part of the junk bond market that defaulted first. But once they default, bond buyers start questioning everything and everything starts rolling over. And especially if the economy gets worse. So, in 2008, I always remind people, yes, the subprime crisis in the US, which was only 4 states largely, California, Nevada, Arizona, Florida, triggered a global downturn. But you couldn't have had a global downturn unless demographics were unfavorable, becoming unfavorable, and debt ratios were at unprecedented levels. And we now have more debt than ever. And most of the debt since 2008 has been accumulated in the emerging world, which is less credit worthy and dependent on commodity prices, which do what? Keep collapsing. We have a 30-year cycle. It was due to peak between 2008 and 10, and boy, did it. Mid 2008 and the second peak in early 2011, commodity prices are going to be down for years. So this is going to kill the emerging world. China slowing exacerbates that. The emerging world still has good demographics, but they depend on commodity exports for their growth, and so they get impacted while the developed world, outside of a few small countries from Switzerland to Sweden to Australia, and these are all small countries, they're the only ones that still have good demographics left. The United States, UK, France go sideways. The rest of the developed world goes down like Japan. And Germany is the worst in the next 7 years. Germany is going to be the big surprise. They're supposed to hold up the Eurozone, and they have worse demographics than Greece and Portugal. Ooh, ouch.
One final point, because I know you got to run soon, but if we do have this play out and we have asset prices collapsing and so on and so forth, Doesn't the U.S. through the Federal Reserve still have to print a tremendous amount of currency just to pay all of these entitlements that we have, the off-balance sheet liabilities that the government has? Isn't there going to be a tremendous amount? I mean, we have 4.5 trillion now, but isn't there a lot more coming?
Yeah, there is. I mean, we add up total debt, Albert, and everybody thought, okay, we got 18 trillion in the U.S. government debt going to 19 trillion. Private debt is way larger. We have over 60 trillion dollars in total private and government debt. The offsheet, the unfunded liabilities for Social Security and healthcare are 67 trillion and rising by independent estimates at the most conservative. I know people that are projecting more. So that is even greater. And there's no way these are going to be paid off. When my view is we're going to get into a crisis in the next several years when all four of my long-term indicators, and I've honed these over 30 years now, point down. We're going to have a major financial crisis, and everybody, just like labor unions in recent years, are going to get real and say, oh my God, we got to retire at 75 increasingly instead of 65. We've got to means test benefits. We can't afford all these things that have been promised. And a lot of private debt is going to deleverage and be written off as in the 30s, which is very painful. Companies fail, banks fail, unemployment goes up. But the 30s cleared the decks of a massive debt and financial asset bubble, which allowed the economy to grow again. We need this, I call it a financial detox. We need this. Central banks are trying to prevent this or kick it down the road because nobody wants to be the president or prime minister of a country or the central bank head and have the next Great Depression detox on their watch. Nobody wants that. And now they have these new financial drugs, QE, to prevent this. I think this is worse. I am more bearish than I was several years ago because we kicked this can down the road, created greater bubbles. And I think, like you were hinting earlier, it's not inflation in consumer prices in a deflationary era. It is inflation in financial asset bubbles that is where all this printing money is going. And when it collapses, it's destroyed. It's like now you see it, now you don't. Like in magic, you create all this money by magic, you pull it out of thin air, it goes into bubbles and stocks and real estate and stuff, and then when those bubbles burst, it disappears overnight and doesn't come back for a long time. So this is not real.
So if we summarize what you see coming, it's a serious adjustment in asset prices, be it equities, be it real estate, be it commodities. You see a strong dollar, so versus other
only
currencies.
For a couple of years when it gets back to parity with the euro and other currencies, and then I'm not sure, but yes, the dollar's only going up in this crisis as it did in 2008. The dollar went up while gold, silver, commodities, real estate, stocks around the world went down. The dollar and the highest quality government bonds were the only things that went up in late 2008 when the system actually melted down and started deleveraging.
You probably see a pretty serious spike in interest rates coming too then?
Only near term. Well, for any risk bonds, any higher risk corporate bonds, yes, they're going to go up the wazoo like they did in 2008 or worse. But in the Great Depression, which is comparable now, a big debt and financial bubble deleveraging, the highest quality treasury bonds of the government, 20, 30, 10, 30-year government bonds, and the highest quality 20-year corporate bonds actually doubled in value, counting their dividend, their yields in the 30s when almost every other asset category went down or came back flat at best. So you got to be in the dollar. If you're in a foreign country, dollar-based assets, and the best thing to be is the highest quality bonds. And I wouldn't even trust Germany right now because their bond yields are lowest, or Japan, and both of them have the worst demographics ahead. So I'd say U.S. dollar-based fixed income assets and treasury bonds are the best place to be. But I do expect, Albert, from past crises, when this thing first sets in and people realize, oh my God, even quantitative easing didn't work, and central banks can't save the economy, there is going to be a short-term spike where I think 10-year treasuries could go up a little over 3% and 30-year could go towards 4%, the top of a channel we've been monitoring since 1989. And then I would say, man, load up on these bonds. They'll be higher yields than high dividend stocks, yet they will appreciate with deflation and stocks will only go down.
I was just going to say, it's a complicated problem, scary problem, but with a fairly simple solution, as you just outlined, right? Yeah. Cash, high-quality sovereign U.S. bonds.
Or put a little bit of your portfolio as a hedge, or short. You can short stocks and stuff. Just don't do it on leverage. Only buy something you can hold and say, look, if stocks going down, I'm going to make some money. Or at worst, I'm in safe stuff. And when they go down 60, 70, 80%, as in every major crisis like this, I'm going to be able to buy stuff. It's a sale in a lifetime, like Joseph Kennedy did in the early 30s, and make money for many decades ahead. But
All
only
right. Looks like we're out of time, Harry. I want to thank you for coming on the show. You know, one thing I always appreciate about you is this is a tough business, making predictions decade after decade, and when you go big.
I go big.
So once again, here you're saying Dow below 7,000, going even lower than that. Oil down below $20 a barrel. There you have it.
And that's when you start getting interesting in investing long term. Don't do it till then. Better to be safe and sleep at night, or have a small portion of your portfolio short so you make some money if things go down. But I tell you, the people keep coming to me saying, I need my dividends from General Electric and stuff. I'm saying, don't do it. You're going to pay a high price and capital loss for those 2 to 3% dividends. I'd way rather have a 2, 3, 4% long-term treasury bond.
Yeah, yeah. Very good. Thank you so much for that, Harry. It's been a great pleasure having you on the show, and I hope we can do it again.
Okay, great. Thank you.
My thanks to Harry Dent for joining me today. Don't forget to get a free copy of his book, The Demographic Cliff. Just go to harrydent.com. There you'll also find out about his free daily newsletter, Economy and Markets. And don't forget, finally, go to powerandmarket.com for insightful interviews with the world's leading experts in economics, finance, and investing, like Harry Dent. Till next time, take care.